All right, so here we're going to be talking about the recognition of revenue and how we create those journal entries for a governmental entity. Recall, this is going to be somewhat different, and more than somewhat, it's going to be significantly different than what we do in a for-profit entity. But that's going to be the case with a lot of what we talk about in this class. So just as a reminder, we don't have a lot of exchange transactions in the government. Right? So a lot of our revenues, most of our revenue comes from things like taxes or from grants, donations, things like that. So we don't have anything that we would call an actual exchange transaction, and therefore we're using that modified accrual basis of accounting where we recognize revenue when it's measurable, aka we know how much we can estimate how much we're going to get, and available, meaning we can use those resources to pay current liabilities and expenses. We've got them in the current year or close enough to the end of the current period that we can still use them for those current liabilities and expenses. So in the case of this class, it's going to be typically 60 days is what we're going to think about. So I mentioned, we have those non-exchange transactions. Basically, it just tells you right here, it's a pretty simple explanation. The government is going to get money. They're going to get funds without giving anything of equal value in exchange, right? We're not providing any real service or anything like that. Again, you could think back to the fire department. That is a non-exchange transaction. We are paying taxes so that fire department can come out and put the fire out at our house or whatever the case may be without them sending us an invoice for it, right? We're not actually paying to have them do that. So again, the most common form of this is going to be tax revenues, right? Or grants. Those are the two big ones. Those are the ones we're going to talk about the most in this class. So income taxes, property taxes, sales taxes, those kinds of things, grants from other governments, particularly when you're thinking like local government getting a grant from the state government or state government getting a grant from the federal government. Those are going to be non-exchange transactions. Those are the kinds of revenues that we're only going to be able to recognize when they're measurable and available, since there is no exchange of a good taking place. But before we can recognize those, much like with revenue recognition in a for-profit, there have to be certain criteria that are met by the governmental entity before that revenue can be recognized. And these, those are our eligibility requirements, and we've got them listed out kind of right here, right? So you've got to have the required characteristics of the recipient. This means that the recipient must have the characteristics specified by the provider. So if they say you need to be a fire department in order to receive these funds, then you are in fact a fire department or a fire district or whatever the case may be. You may have some time requirements. So for expenditures, they may say you have to spend these within a certain amount of time, or you have to hold on to these for a certain amount of time. Those can be provided by a covenant. They can be provided by some kind of governmental legislation. So let's say that a local government earns or gets a grant from a state government, and the state legislature said, hey, you have to have these spent by June 15th. I know I run a student organization here on campus, and we get SOFAC money from the university. So our little student organization is kind of a government, think of it like a governmental entity. We've received a grant from SOFAC, but we have to have those funds spent, before June 15th. That is essentially a time requirement, right? There may be reimbursement requirements. All this means is that for some grants, they require that you spend the money first and then you submit to them for reimbursement. Again, SOFAC, I think, is a good example of this for, at least for my organization, because we can either directly apply for the funds and say, hey, we want to take our $2,000 or whatever we've been granted, or we can apply for reimbursement, meaning we just go ahead and we spend our own funds on it, and then we apply for reimbursement, right? And that's kind of what this is. There are some grants or some organizations that may require you to spend the funds first, prove that you've spent the funds in the way that you said you were going to, and then they will reimburse you for those. You really only get to recognize that revenue after the expenditure has been incurred. The last one here is contingencies. So any contingency that is attached to the funds that you have received or the grant that you have received, you cannot recognize the revenue until you have met the contingency that is attached to that fund. We will get into examples of those later. So we have 4 different types of non-exchange transactions, and as we go, we will go through each one of these with examples, and then we will work through a journal entry or a couple journal entries for each one of these so that you guys are familiar with those. So the first one is imposed non-exchange revenues. So those are property taxes, any special assessments, fines, or forfeits, meaning getting pulled over by the police and getting a ticket. Those are all imposed. They are something that the government is imposing on you. They are forcing on you, right? You don't have much choice in any of these. The next one is derived tax revenues. So this is going to be like sales tax, income tax, motor fuel taxes, right? Another action has caused you to have to pay that tax. So that tax has been derived through another action. So purchasing a pair of jeans at a store at the mall, the sales tax is derived from that purchase. The sales tax is triggered by making that purchase. Income taxes are derived from the fact that you work and get paid an income. You don't pay income taxes until you get paid an income, right? The third one is government mandated transactions, and the fourth is voluntary non-exchange transactions. And we'll go over those kind of at the same time. There'll be a couple different journal entries there, but we'll talk about them at the same time. So the first one are these imposed non-exchange revenues, right? So again, this was the property taxes, any kind of special assessment that you have, fines from speeding down Battlefield, all those kinds of things. So you record the receivable or an allowance for uncollectibles. I mean, this is very much like AR and bad debt for a for-profit entity, when you can enforce the claim, right? So revenues are recognized in the period in which the taxes are levied, i.e. when we budget them. So when we do that estimated tax revenue we talked about in a couple videos ago, you've got your estimated tax revenue. That's when you're recording your budget. You're also going to recognize the revenue in that period because you've levied that tax during that budgetary period. But you also want to take into consideration any tax revenues you may receive within 60 days of the period ending, because you could still use those funds technically to pay off current liabilities, current expenditures, things like that. And then you also have to record any revenues that you expect to collect greater than 60 days after year end. But what we're going to do with those is almost kind of like unearned revenue. We're going to create a little bit of a liability account. It's going to be the deferred inflow of revenues or deferred revenues account. So let's say we've levied a tax, we've recorded the budget for that, the estimated tax revenues for that. So we're going to record taxes receivable, right? This is just like an AR account. We're expecting to get paid all of these taxes. However, we know that we're going to have to, that not everybody's going to pay those taxes, or at least not everybody's going to pay them within 60 days, right? So we're going to create that estimated uncollectible taxes account. That is kind of like almost like your allowance account. And then we are going to credit revenues control. Now note, revenues control is a very high level, kind of a general ledger type account. It is just revenues, right? You may see taxes, tax revenue, or income tax revenue, or sales tax revenue, or something like that if you are looking further down into the subsidiary ledger. But for right now, I'm really happy with us just understanding that we are going to record a revenue. So we're going to record at that control account level. Just note that in your homework in the book, they may record at the control level, or they may record at that subsidiary account level as well. So in the second one, we're going to look at a portion of those taxes that we expect to collect greater than 60 days after the year end. So we're no longer going to be able to use those for our current resources. So yes, it's measurable, but no, they're not available, meaning we don't get to recognize them yet, right? Under the modified accrual basis of accounting. They're measurable. We've got an estimate of them, but they're not available to us. So we're going to debit revenues control, which is the opposite here. We're going to take away from our revenue account, and we are going to credit deferred property taxes. This is just like you know, almost like unearned revenue. It's just a deferred revenue account. It's kind of a liability account. If you got any questions about this one should be somewhat familiar to you. Maybe not familiar, but somewhat comfortable for you. It's not too different than what you would typically see us doing in a for-profit. It's just right now we're pushing those off and we're saying, yes, they're measurable. Yes, we got an estimate of how much we might collect, but it's not available to us. We're estimating that this portion of it is not available for us to cover current liabilities. So the next one to talk about is these derived tax revenues. So these are your sales taxes, your income taxes, your fuel taxes, all of those kinds of things. So again, we're going to recognize it when it's available and measurable, and available. Again, we're going to defer some if we don't expect to collect any of it, some of it in time to pay off our current liabilities, because that violates the availability rule of it, right? It's got to be measurable and available for us to collect, but if it's not available within that 60-day period after the end of the accounting period, then it's no longer available to us and we no longer recognize that revenue, but we are going to defer it. So if we look at this first example, let's say income tax withholdings. We've received those withholdings from the income tax. You're going to debit cash, very easy. What are we getting? We're getting cash. We're going to increase cash with a debit. And then we're going to credit revenues control. This is one of the easiest journal entries you're going to see in this class. You should be very comfortable with this. This is just a cash journal entry. What did we get? We got cash. So we're going to recognize that revenue from withholding those taxes. So the second part of this journal entry, the second journal entry, is that we're going to expect to receive some amount of taxes, some additional income taxes after year end. Part of this, though, is not going to be received in time to be available for current liabilities. This violates the availability, so we're not going to recognize those. We're going to defer that portion of it. So we're going to debit taxes receivable, right? It's an asset account. We're expecting to receive these. This is an AR, right? It's a receivable account, so debit to increase it, taxes receivable. We're going to credit revenues control for the portion that we expect to receive currently, that we expect to receive during this period, during the period that the taxes were levied, or within 60 days of that period, right? Those are what we expect to receive currently to be able to take care of current expenditures, current liabilities, that type of thing. So we're going to credit revenues control for that. Again, revenues control is a high-level general ledger account. This could be income taxes control if you were looking at the subsidiary ledger for it. Now, finally, we're going to have to credit the deferred revenues income taxes. This is the portion that we don't expect to receive in time to pay current liabilities. This is the portion of it that violates that availability portion of our measurable and available, right? So again, this is just kind of a liability. We're deferring that revenue to a future period. So, yeah, that's really it for this one. I don't know how to get much more into depth on those, but if you do have questions, again, please keep looking through the Chapter 3 material or contact me, and I'm happy to get on a Zoom call or email with you or whatever the case may be for you to kind of process these journal entries for revenue recognition. So the third and fourth ones, we had government mandated transactions and we had voluntary exchange transactions. So this government mandated transaction, let's kind of think about this as you haven't met all, or you've finally met all of the reimbursement requirements, right? So most grants, a lot of grants are reimbursement grants. So in the case of revenue, we only recognize that revenue when the expenditures have been incurred. We talked about that earlier. So, like I said earlier with the SOFAC example, we can apply for reimbursement of those, and we can say, hey, we bought these things. We know they qualify for reimbursement from you guys. Here's our receipts. Here's all the paperwork you need in order to actually reimburse us. The expenditure has been incurred, right? So what we're going to see here, this is your government mandated transaction. This is your first example. Your first journal entry here is that the expenditure takes place. Very simple. You should be comfortable with this. This is just an expense journal entry, right? So expenditures control, that's your expense account. You're going to debit it to increase it. You're going to credit either your accounts payable if you're paying on credit, or cash. Typically, I would think of this in from a cash perspective. A lot of these journal entries are much easier to process if you think of them from a cash perspective. So again, you're going to credit accounts payable to increase accounts payable, that liability, or you're going to credit cash to decrease your cash if you divvied out cash to buy whatever good you were trying to buy. So the second journal entry is that you recognize the grant revenue finally, because you've met that expenditure requirement. You have incurred that expenditure. Now you can recognize that, recognize the revenue from that grant. So you are going to simply, while you're waiting for the cash to come in or whatever the case is, you're just going to create a new account, and this new account is called due from grantor. So in this case, it's the grantor. It could be due from fire department, could be due from police department, could be due from city utilities, due from whoever. Just start associating the term due from with a receivable account. It's basically an accounts receivable. Okay, so when you see due from, think a receivable. When you see due to, it's kind of like a payable, and we'll get to those later on. And then you're just simply going to credit your revenues control. This is the recognition of that revenue. You finally performed whatever criteria or requirement needed to be met in order to recognize the revenue. In this case, it was the fact that you needed to incur that expenditure. You did so. You proved it to them. Now you can recognize the revenue with a credit to revenues control. Again, a general ledger account. So the next example is going to be one where we get the funding in advance. So they give us the cash first, right? So this would be the example that I gave you earlier, where we, instead of submitting for reimbursement from SOFAC, we just say, hey, we want to buy these things. Can we have the cash for it, essentially? So the first thing that's going to happen is that you receive the funding in advance, right? So you're going to debit cash. Pretty simple. What did you get? You got cash, increased cash with a debit, and you're going to credit your deferred revenues or grants, right? You haven't actually spent that cash yet. You haven't incurred any expenditure yet, so you need to defer that revenue. You cannot recognize it yet. So finally, next in the second journal entry, the first part of the second journal entry, you actually incur the qualified expense. So say we bought a camera which qualifies as a it's a qualified expense under the SOFAC policies, so we are now able to debit the expenditure, right, and credit cash. This again is a very simple expense cash for an expense journal entry. Debit expense, credit cash, increase the expense, decrease your cash. So that's going to be the first part of your second journal entry. The second part of that journal entry is going to be finally to recognize that revenue, because now we've incurred that expenditure, so we can finally recognize that revenue. We have met that requirement of incurring the expenditure, so now we recognize that revenue. And we're going to do that by debiting the deferred revenues or grants. Okay, so we're going to reduce that account, that liability account that we created up in journal entry number 1, and we're going to increase our revenues control, that general ledger revenue account. We're going to increase that with a credit.